Okay, good evening, ladies and gentlemen. Okay, I know y'all won't say, so I wave to you, okay? So if you wave back to me, I know that y'all are listening. It's a cozy session, right? So don't make it so formal. I want to deliver value to you as much as possible to share with you more of the analysis about stock investing, right? So I know that for retail investors, usually one of the key issues is like, how do you look at the stock, right? How do you know whether a stock is good? How do you know whether a stock is overvalued, undervalued? So I want to extend that to you in this session. And of course, we will have a Q&A at the end of the session, and feel free to type in a question, okay? Because nowadays, we don't like to talk, right? We only, even two people in the same room, we will text each other. So same thing, you can just go to this website, you can see that information, pigeonhole.at, and there's a passcode, or you can just scan the QR code, and that's where you can type in a question. So I will answer questions along the way, unless you are so enthusiastic, you can raise your hands and ask the question, okay? Otherwise, we will leave it till the end of the session and we will have the discussion. So, I haven't introduced myself. I'm Alvin. I'm the CEO of Dr. Wealth. Anyone have came across Dr. Wealth website before? Only a few. Okay. All right. If those haven't checked it out, please, you can go and take a look, drwealth.com. We share a lot of informative content, articles, even videos on YouTube you can find about investing in general, okay? But today I'm here in a capacity as a SGX Academy trainer. So we will focus on talking about this new launch, this Thai SDRs, okay? That's the list that's traded on SGX. And I want to give you an analysis of these stocks, okay? So, okay, this one we covered already. Of course, usual disclaimer, it's all my personal opinion, right? So please do your due diligence if you want to take any action on these ideas. So this is the new thing, right? It's called Singapore Depository Receipts, or SDRs in short. And some of you might be familiar with the ADRs, right? The American Depository Receipts. They are similar in that sense, okay? But this SDR, of course, is the Singapore-based product that is traded on SGX. And I will not talk about the details of the SDRs. I'll focus more on the stocks themselves. But of course, later you have questions on SDR, we can talk about them. Okay, just ask about products. But I thought it's more beneficial for you if I jump into the stock analysis. Okay, and the three initial Thai SDR that SGX have launched are this CPO, AOT, Airports of Thailand, and this PTT, Exploration and Production Company. So you can see they are not in the same business. And we will go through one by one and what are the investment merits. And of course, we also will talk about the risk, okay, regarding these stocks. So the first one, the name for Thai names always very difficult to pronounce, okay? I won't even try, all right? I just call it CP Group. Some of you might have heard of it before, some of you might not, but definitely you have seen this product before, right? Anyone have seen this product in the supermarket? Yes. Yeah. Okay, they tend to be more expensive than the other brands. Okay, I got cheated once because you can tell I go grocery shopping. So I was buying the frozen chicken, and I saw it like $8+ for one pack. So then I saw the other brand. I forgot what brand it was. I think Sadia, which is I don't know from where, probably Brazil, and I saw that was $9+. So of course I bought the other one, right? $8+. Then I realized the CP one was 1 kg and the other one was 2 kg. Okay, so I got cheated in that sense. So must be very careful. Cannot just compare the price. When you look at the stock, also the same thing. Doesn't mean the stock price lower is cheaper. Okay, you must compare with the fundamentals that you're gonna get. But the stock that we are talking about is not related. It's not the owner of this CP Foods. Okay, they are related in the sense that the frozen foods, all these are part under CP Foods. The one that we are looking at is CPO, but it is still part of the CP Group empire, right? And the family behind this CP Group is the richest family in Thailand. Okay, they span a lot of different kind of businesses, but we focus on this CPO, which runs the retail part of their empire. Okay, so that is Of course, if you want to look at other things, it's going to be a lot more complicated. Anyway, this CP Group is a private company. You cannot invest in it. Some of these are listed, right, but not all. Okay, the one that we're looking at is this CPO. And what are some of the businesses in this CPO? The very first thing that we want to talk about is this 7-Eleven. Okay, they are the exclusive operator of 7-Eleven in Thailand. And that can be extended to Cambodia and Laos. Okay, and people think about 7-Eleven, what's so big deal about it? Correct or not? Okay. In Thailand, the number of 7-Eleven stores is a lot. Okay, so it is the largest, it is the country with the largest number of 7-Eleven outside of Japan. Okay, 7-Eleven comes from Japan. Okay, naturally, Japan will have the most number of stores, shops. Okay, and then you look at Thailand is number 2. That's even more than USA and China, which are tremendous big market. Okay, so you can see the convenience store in Thailand plays a very critical role in their lifestyles. All right, it's a bit different from here when we're based in Singapore, right? It's not a usual place where you will first think of when you go to buy groceries or buy stuff. Mostly, if you are very, very thirsty, then maybe you'll walk into a 7-Eleven, correct? Okay, especially after a run, but usually Singaporeans don't run, so you rarely go into 7-Eleven. Okay, and it is integral to the Thai lifestyle. The fact is that 1/3 of the grocery shopping, right, is done through 7-Eleven in Thailand. In Singapore, we don't really do that. Even though some of the 7-Eleven, I started to see some groceries being sold. But the problem is that in Singapore, there is always a supermarket that's very near you, correct or not? And usually you just go to the supermarket because relatively it's cheaper. And sometimes it's not a supermarket near you. You might have 3 to 5 choices that are near you. Okay. Instead of you going to the supermarket, they bring the supermarket to you. Right? So that is the Singapore strategy, which is possible because Singapore is a very small place. But Thailand is not a small place. You cannot afford to have a supermarket in every village. It's just not possible. So convenience store become, as the name suggests, convenient, located close to their homes, their office. Okay, because it's lower cost to set up and you don't need to stock up a lot of things. So that can also help with your inventory management. Okay. And it's also this volume of grocery shopping in convenience store, right, is also one of the highest in the world. So it is not surprising. That is why there are so many 7-Eleven stores in Thailand compared to many other countries. And second is that they also have this household size reducing, right? Probably the children grown up, they leave the place, leave their homes, and then to start the new homes, and the numbers drops, okay? And that's where the economies of scale is not there, so convenience will trump that cheapness, okay? They don't want to just buy a lot at lower price because they can't finish eating them as well. And for 7-Eleven in Thailand, the price gap between them and the supermarket is also narrower. Okay, so which means that why would I want to drive 1 hour, right, to a nearby supermarket? The nearby supermarket will be 1 hour away. And versus a convenience store, which sells maybe, I don't know, 5% premium, right? You will probably just buy from the convenience store. So you can see there are a lot of all these characteristics and features of the convenience stores. They are very different from our experience over here. And lastly, they also have a diverse range of products. They even have pharmacy in some of these convenience stores. So you can imagine it's like having a Guardian or Watson pharmacy in a convenience store, which I think actually it makes a lot of sense, right? So that is how their convenience stores are like. And this 7-Eleven does have competitors in Thailand. It is not a monopoly, it's an oligopoly market, which means there are few big players. Lotus Go Fresh is the second largest market share, right? Compared to 7-Eleven is 74%. So it's very dominating. Then there's Family Mart, which is also from Japan, and others make up the other 12%. Okay. And the other thing is that this Lotus Go Fresh is also part of CPO. Okay, so which means CPO convenience store market share is 74% plus 9%. That gives you 83% market share. Okay. So when it comes to investing, I I always prefer to buy market leaders. And market leaders are generally these companies that dominate the majority of the market share. Okay, so this is one of the aspects that you want to check it out, right? When you want to see whether this stock versus another stock, whether is it worth buying, and this is how you can size them up. Okay, and the rule of thumb, general rule of thumb, is not always true, but general rule of thumb, most of the time is true. Go with the market leader is always safer. All right. So this is definitely no doubt CPO is a market leader in convenience stores in Thailand. Okay. And it's not just staying stagnant, it's still growing very well, right? In this year, they are going to open another 700 7-Eleven stores, okay, in Thailand. And they have expanded to Cambodia, 42 in 2022, and another 58 this year. And they are going to start their first store in Laos. Okay, so there is expansion, which means there is growth potential. It is not just staying stagnant where they are growing their pie some more, right? They are going to grow this market share further. Okay, that's what investors want to see as well. That is the convenience store side. So this CPO also have the supermarket arm. Okay, so whether they go for the convenience store, which is nearby, or they go all the way to another supermarket, they will make the money, okay, regardless where they get the grocery. And under the supermarket business, they have two brands. One is Macro, one is Lotus. Okay, so what is the difference? Macro is more like a B2B business. They sell to other smaller businesses who may open their provision shop or their convenience stores, whereas B2C is business to consumers, right? Which is directly sold to the buyers like you and me, okay, where we go supermarkets to buy groceries. So to give you some relevance, Lotus is like our NTUC, like our Sheng Siong, okay, where we go there and buy, right? Then Macro is more like a Costco in the US. Okay, in Singapore, we don't have like a Costco equivalent. We used to have Big Box. Do you remember Big Box? Anyone? Yes, where is it now? Gone already. Why gone? Because you never buy. You never buy in volume because our birth rate too low. Right? Not enough people in the household. You go and buy one whole carton of toothpaste you use until when? Okay, so that's the situation, right? But that's why the macro kind of business, they call it a wholesaler. It's more to sell to the smaller retailers. Okay, it's more of the B2B market. But of course, over the years, they have expanded into different kind of teams. Right? They also went to the smaller format. Okay, so it's a lot more diverse. But relatively, you can see the number of stores. Okay, number of shops. Well, Lotus is a lot more compared to Macro. All right, and it's not just in Thailand. Okay, you can see some of you travel to Malaysia, right? They also have Lotus Market there. So the Lotus supermarket in Malaysia is also under CPO. Okay, and you can see there are other here for Macro. All right, so that will give you a bit of sense. But of course, majority of the business will come from the Thai side. Okay, now let's look at the contribution to their revenue and their profits. Okay, so when a company like CPO has a lot of business segments, right, it's important to see how they make their money. Okay, where is their revenue generated? Sometimes it might be the case, oh yeah, you have 7-Eleven, you have supermarket, but which one makes you more money? Okay, so this is where you will look at their breakdown. This on the left side is your revenue breakdown. You can see about more than half comes from the supermarket side. CVS stands for the convenience store. Then 42% comes from the 7-Eleven. The others you can ignore. Okay, so it's about half, but the supermarket is slightly more than half. But when you look at the profit, this is earnings before tax. You can see which is the more profitable business, convenience store or supermarket. Which one? Convenience store or supermarket? Convenience store, right? Because you can see the profits contribution is almost half. Okay, while the supermarket contributes the other 38%. So which means the convenience store, despite lower revenue, contribute more of the profits, which means the profit margin is naturally higher. Which makes sense, right? Because we all know that convenience stores usually will price at a premium compared to supermarket. Okay, so that is the more profitable business. And with that in the back of mind, then at least when you buy a company like CPO, when you monitor their news, you would understand the impact. For example, if you see maybe a 10% drop in revenue for supermarket, it will not have as much as an impact to the profitability for CPO as compared to a 10% reduction of revenue in 7-Eleven stores. Okay, so by understanding where is their profit driver or revenue driver, that will give you a good sense what kind of news and what kind of impact. Right? This is the multi-year revenue, and this is something that you also want to watch out for. You want to see some growth. Okay, especially if you are more of a buy and hold investors, growth is important. If you are the punting kind, then doesn't matter. Okay, so you also must look at what you are doing. What is your investment objective? Because if you are more short-term buy and sell, fundamentals don't affect much of the share prices in the short term. Right? Because minimally the results takes another quarter to come out, minimally 3 months. Okay, if you trade within 2 weeks, it's not a fundamental thing, right? It's more of a market sentiment. So if you hold a stock over many years, then definitely fundamental plays a bigger part. Okay, and if you want to hold a stock over several years, you do want to see the growth, right? Because only growth can increase the value of the company and then pushes the share price higher. Okay, if there's no growth, then you want to look for dividends, right? Because that's the key source of your returns really. If there is no revenue growth, no dividends, then you have to buy very cheap so that the price rebound, okay, to this fair value. Yeah. So if you are more of a buy and hold, so for CPO, it's more like a buy and hold stock. Right? It's not so much of a stock for trading. It's not so much for a stock that you can buy at very undervalued price because it's still a blue chip. Blue chip rarely trades very cheaply. Okay, so these are some of the characteristics of the stock. And this is where you want to see that there's actually a big jump here, right? Otherwise, for the past 4 years, it's actually been flat. And we also understand that what happened in 2020 and essentially 2021. What happened in these 2 years? COVID, right? Yeah, cannot remember one. Okay, yes, a global impact. Not just in Singapore, but everywhere else. So in 2020, 2021, there's COVID, and you see the revenue didn't grow so much in those 2 years. Okay, it's actually acceptable, right? Because there's definitely an impact. And if their revenue never drop a lot, it's considered quite resilient already. Agree or not? Okay, so the good thing about now you have some comparison, and you want 2020 to what? Bounce back, to recover strongly. Okay, so that's how you look at a historical trending chart. You have to see whether the business can perform in the worst of times and whether it does rebound when the recovery comes. Okay, so we pass the test in this case, right? Next thing, net profit. Can you tell me, good or bad? Good or bad? Again, same thing, right? 2020, 2021, give some chance. Okay, but 2022, you want to see the profit come back up, right? Just like the revenue, right? You see the revenue bounced up a lot, but the profit didn't. Just went up a bit from 2021. So this is a sign where you need to dig deeper. What's going on? Why did the cost go up? Right? Because essentially revenue jumped a lot, profit didn't go up a lot, means our expenses went up. Okay, and in 2022, what can we think about? Probably, can it be an inflation problem? If it's an inflation problem, would the expenses go up? Utility, labor, raw materials, possible, right? So that's one possible reason. Okay, so you must have some backdrop to help you analyze what's going on. So in this case, go and dig. But actually, it's not an inflation problem. Probably a little bit, but it's not the key problem. So after digging a bit, what I found out is that they did a restructuring. Okay, it's a bit complex, but I'll just simplify for you, right? So basically, Macro was also a listed company, and Lotus was a separate structure, right? So what they did was that they parked Lotus under Macro. So they have a major restructuring, right? So which means that they absorb all the expenses, okay? They also absorb all the revenue, right? But which means that the merger has not achieved the synergy yet, which means in the next 1-2 years, you want them to do cost cutting. Then the profits will go up. Okay, that would depend on the management execution. All right. So what I'm trying to say is that when you look at numbers, you must be able to tell where is the thing that you need to take note of, and then you go and figure out what's going on. Okay, but I know most people don't correct? Can buy no? easiest to get an answer. Okay, but I do think that you at the end of the day, right, you have to understand your stock. If you don't understand your stock, right, when the stock go down in price, right, you're panicking on. Okay, holding power is very easy to say. Right? You only have holding power if you really understand what's going on. Okay, that's what the price to pay. You gotta buy individual stock. And the other thing that we want to see is growth, right? I told you, right? So growth, not just in the revenue, growth in the profits, growth in the cash flow generation, and growth in this case, the dividend stock. You want to see the dividend grow as well. Okay, so it's been a steady dividend grower, right? Then again, 2020, 2021 give chance. Okay, then now there's a bit of rebound, right? But it cannot give super high dividend, right? Why? Because their profits is lower. Okay, so the story gels, right, which is okay. But in the next few years, you want this to gradually recover and go up again. Okay. And these are some additional financial metrics, right? Their 5-year annual growth rate is about 12%. Okay, anything in the teens, that means over 10%, right? It is still a reasonable growth. Okay, you don't want a stock that grows 50% 1 year, then next year grow 2%. Those kind of very unsteady growth is not, the business usually is not very resilient. It might be even a cyclical stock. But a stock like this, everybody understands, right? It's a consumer staple. Good times, bad times, supermarket, convenience stores will tend to have their customers because you're talking about daily necessities, right? And still can grow at 10+%. I think this is quite remarkable already. Because if you compare to those like Walmart in the US, you're not going to see this 10% growth, right? Pretty much saturated already. Okay, which I think for the convenience stores, they have a lot more growth engine, right, as compared to the supermarket. As we talk about the lifestyle in Thailand is very different. And looking at their PE, right, 43 times. To a lot of people, 43 times is like, wow, that's very expensive. Correct or not? Agree? Or don't know? No concept of what is cheap and expensive. Okay, typically you talk about index PE is about what, 15, so you can think it as an average. Average PE for stocks is about 15, but of course different sector, different businesses will have different kind of multiples, right? And for this kind of business, right, we already established very resilient. Okay, and for this kind of resilient business, PE 40-ish is very normal one. Okay, and to know whether it is cheap or expensive, I always like to compare with their 5-year average. Right, so the 5-year average is about 38 times. Okay, but don't forget, PE, right? What is the fundamental value that we're taking from? Earnings, right? Correct or not? Okay, and what happened to their latest year earnings? High or low? Low, right? Relatively lah. Okay, so if their E is low, what will happen to the P? The P will be high, right? Correct or not? So if we expect the synergy to come in, the expenses to go down, the profits to go up in the next few years, right? You might also can use a forward PE in a sense. That means you use a projection. Instead of using a historical PE, use a forward projection, especially you know that something positive will come. All right? So it might not appear as very expensive. Okay? Forward PE maybe below 40x. Right? Close to about fair price, I would say. It's not that cheap. Okay, but it's not overvalued at the same time. So it's just fairly priced. And you can look at other metrics as well, right? Free cash flow yield. I won't explain what this is, but this is one of the way to measure their cash flow generation ability at 6.8%, which is higher than 4.7%, right? So actually their paper earnings is paper profits, right? Cash flow is real cash that's coming in the company. So actually in terms of the real cash, it's still considered higher than the 5-year average. This is a good thing, right? You're yielding more on cash flow compared to the past. And dividend yield is not high, right? This kind of stock, usually they don't give you 5-6% kind of dividend yield. Okay, very resilient consumer staple. 1-2% is going to get. Okay, so you don't buy this for dividends. You buy this for more for capital gains. Okay, share price appreciation. right? But your yield will increase. Why? Because when they grow their dividends, your dividend yield will go up, even if you don't add position. Okay, but still, this for the yield, right? Another thing is that the debt to equity tend to be a bit higher. Okay, but again, because it's a resilient business, supermarket, all this, the banks are probably also willing to lend them money to mortgage the properties. Okay, so I don't see this as a problem for CPO. So in general, it's a good business, resilient business, fairly priced at this moment. Okay. Okay, Sun mentioned already, right? Maybe I will just add in another point that I didn't mention just now, which is this network effect and cost advantages. Okay. Oh, just now forgot to mention, where the supermarket market share, I think, is over 70% in Thailand. So they are number one in convenience store, number one in supermarket in Thailand. Okay. And that will give them competitive advantage, or what Warren Buffett called the moat. Right? Two potential competitive advantage I can think of is network effects and cost advantages. Okay, cost advantages is easier to explain because when you have more stores and you order inventories, you order in bigger volume, the price you can press down. Okay, so that is the economies of scale or cost advantages. Smaller player can't do that. Okay, so that is where others will find it hard to compete. And the other one, network effects, is more like relate to Singapore, right? Like NTUC. Okay, if there are many NTUC around you, it is more likely that you will apply for, say, NTUC membership, because the utility of the NTUC membership is higher. All right. If there is only one supermarket in the whole country, and they ask you, hey, would you want to sign up for membership? You'll be less inclined. And I give you an example is that near my place, there's a Prime supermarket, there's NTUC, there's Sheng Siong. Okay, then the Prime asked me whether I want to get a membership. I say don't want. Would you want or not? Why wouldn't most people want? Because you realize that you will not utilize it much. Okay, especially if it costs money. Okay, free one. But free one I also don't want because it takes up space in the wallet. Okay, and you're going to use it. So that is the idea about the network effects. So when they have enough stores around, they will start to have the mind share, and it's a lot harder for you to switch out of their network. Okay, so that is the two competitive advantage that CPO have. Next stop. I think I'm a bit behind time. I must speak faster. Next stop is this airport of Thailand. Anyone have traveled to Thailand after COVID? Okay, got a few, All right. So you will have contributed revenue to them. Okay. And some interesting thing that I found out, right? This airport of Thailand is the largest stock in Thailand based on market cap. And not only that, it's the largest airport stock in the world. Again, based on market cap, not based on revenue. Right? So you can see that it's a blue chip. It's not like some Tom, Dick, Harry stock that we are talking about. And it is not surprising because it is a monopoly. Okay, it owns the airport in Thailand. And if you go Bangkok, likely you'll alight here, Suvarnabhumi Airport, correct? Or otherwise Dom Myong. These are the two, and you can see the capacity. Almost half goes to Suvarnabhumi, and the other 30% goes to Dom Myong. So about 75% is captured in these two airports, because these two are the biggest international airport in Thailand. Okay, these two are close to Bangkok. Then Phuket has their own, Chiang Mai has their own. Right, so they own all the airports. Okay, so it's a monopoly. How would you want to buy monopoly? Of course, no competitor one. Better than oligopoly. Okay. By the way, monopoly is illegal one, correct or not? Because how can no competition? Right? How come they can have a monopoly? Because the government owns majority of it. Okay. Only the government can allow monopoly if it is owned by them. Okay. So they make it available for you to buy, right? Okay. Would you buy Changi Airport Group? if it's listed? Will you? No? No? Don't like? You don't like airport? Huh? Say only. Okay. So you can see this is Ministry of Finance in Thailand. It owns 70% of the this airport of Thailand. Okay. So this is a good sign in the sense that you have the government's backing, right? And you know that this monopoly will carry on. Okay. And they decide the pricing, right? So there's no alternative. You want to go Thailand, you have to use their service. It is confirmed one. Okay. You cannot say, never mind lah, I fly to KL, then I take bus. or I fly to, I don't know, Ipoh, then I take boat. Penang. Doesn't make sense, right? So that is a good sign that this kind of monopoly will make money from you. And they don't just make money from you, they make money from all sorts of things, like the real estate that they lease out to the shops, restaurants, duty free, right? When the aircraft park at the airport also costs money. Okay, so every inch of the airport can make money, man. All right, so that is how good a business model is. But majority of the business, right, actually, or the revenue will come from this departure passenger service charges. What is that? When you leave Bangkok, do you need to pay tax? That is the revenue. That is the key revenue for this airport of Thailand, right? So currently it's still the majority, but I expect this pie to be probably half of the total revenue of airport of Thailand. Okay? Yeah. Why? Because the passenger traffic is recovering. Okay. Another thing that we want to compare, right, is actually 2020 is not a good comparison. We want to compare 2019, a full year before COVID happens. Because year 2020, around March period, the lockdown start to happen already. So the travel have already impacted. But from this chart in 2022, okay, we can tell that the travel industry in Thailand has not fully recovered to pre-COVID levels yet. Is this a good thing or a bad thing? How? Good thing or bad thing? Why is it good? Yeah, there's no upside, right? If fully recovered, there's no upside to talk about. Okay, of course, that boils down to whether you believe travel will fully recover. Okay, right? Personally, I believe it will. I will also believe that it will eventually surpass the 2019 numbers. Right? Because before COVID, the tourism numbers have always been going up steadily. Okay, especially with low-cost carrier, it's a lot easier to travel nowadays. Yeah, and you can see generally the recovery has been very strong. Okay, even there's an acceleration for the first 6 months of 2023, up 200%. As compared to 2021 to 2022, there was only up 133%. And you can see the key airports, right? BKK plus DMK is up more than the other airports. And these are the key revenue drivers. So these are healthy signs. That means the international travelers are coming in. Right? This is the trending that you can see. So a lot of all this information I get from the slides. And so some investors they feel that, oh, I don't know this Thai SDR listed in Thailand. Will I get the information? Is it in Thai? But actually it's all in English. Okay. So a lot of all these screenshots are from their slides, the presentation. Okay. So this is another one to look at. We want to focus on just two lines. 21.9, which is this light purple line, and 22.3, which is this dark purple line. Right? Can you see there's still a gap to recover to? All right. So I believe that eventually it will surpass. I just don't know when. Okay, but I believe that it will. Right? Unless there's another pandemic happen. How? Then it doesn't matter anymore actually. Okay. I doubt so. I doubt so. Right. You roughly count when was SARS? SARS was about what, 2004? 2004, then 21.9, about 15 years. Okay, maybe 10 years later. Right, we have another pandemic. Okay, not in the next few years. I don't think so. Anyway, our antibody all out already. Okay, a lot more resilient. This is the AOT financial, right? So maybe I'll just show you how I read this. Then you get a rough idea what I'm trying to convey. Okay, you can see that for first thing, 2021, 2022, they make losses. Okay, actually look at this. Right, bracket means negative, they make losses. So even for the full year of 2022, after some recovery, the airport business is not profitable yet. Okay. Then for the first 6 months of 2023, it has turned profitable. Good sign. And yet they haven't fully recovered yet. Okay, so that's the first thing you want to see. Second is the revenue, right? 2019 is 64 billion baht. Okay, then drop half. Then drop until don't have. Then recover 17. Okay, then now first 6 months, about 20 lah. So which means for the second half, maybe another 25, you get about 45. It's still way below this number. Okay, so that is the room that we are talking about, right? The recovery of the sales. Okay, post-COVID, so we are still not there yet. Maybe, I don't know, 2024, 2025, possible. In the next 1-2 years, it should hit these 21.9 figures. Okay, and if they're already profitable now, and by increasing the revenue further, the profits will expand. Make sense? Make sense, huh? The next thing is, key thing that you want to watch out for is this ROE that stood out for me. For airport business or even the ROA, return on asset, usually for property, because it's still like a property business at the end of the day, right? It's real estate, making use of real estate. For real estate business, the ROA usually single digit one. The ROE depends on how much debt you leverage. Okay, you lever more, of course, the ROE will go up. Okay, so for this airport business, you can see that the ROA double digit ROA, which is very unlikely in the real estate business. So this tells you that the airport really maximizes the revenue and their earnings as well. And the ROE is slightly higher, which also means that the debt is not high. Okay, of course, you can also check with the debt to equity, which is just 28-30%. Gearing is not very high. Okay, it's not gearing, sorry. This is debt to equity, right? Gearing is debt to assets. The other way to look at it is the profit margin high or not? 42%, 40%. High or not? Supermarket also don't have this kind of profit margin. But single market profit margin, net profit margin probably also in a single digit. Okay, this kind of net profit margin, right, is almost like MasterCard, Visa, that kind of profit margin. About half of the revenue is net profit. Okay, but how come 2020 dropped to 14? Because revenue tanked. How come 2021 lost money? Because revenue tanked further. How come 2022 still lose money? Costs haven't fully recovered. Okay, so which means if AOT fully recover, you are looking at this kind of profitability. It's a highly profitable business. Okay, so that's why I would say if CAG is listed, it's worth buying. Okay. The other problem with this kind of recovery stock, right, is that no matter what kind of fundamental you see, the financial metric looks very sucky. Okay, so that's where you need to adapt. You cannot just look at the financial figures unless you make adjustment, right? Let's say you expect the recovery to happen in 2024, 2025, then you recompute the financial ratio. I guarantee majority of people will do that as well. Only the analysts will do it. So the lazy way is you go and look at the analyst report and look at the projection. And you see, of course, whether you agree with the assumptions. Right? If you agree, then that's where you can look at the figures, then the figures will get adjusted. So you cannot look at the historical numbers. They all look very ugly. Like if you use PE ratio in 2022, what will happen? You get an NA. Yo, how to decide? Correct or not? Okay. So for recovery stock, unfortunately, you cannot use historical financial metrics. You have to either use a projection, okay, when it's fully recovered, or sometimes you can use a bit of like ranging or the kind of like a bit of TA to see whether there's something going on. All right. So you can see, right, this PE or I use PS here. Okay, I use PS here. And I use revenue numbers because the PE is negative. Okay, so which means that you still can use revenue, right, to give you some guide, but I still don't think that this is reliable because your revenue is changing very fast. Okay, it does suggest a bit of undervaluation, in my opinion, because your revenue is going to jump up, right? The price haven't really priced in yet because 33 times versus 52 times, that was the average. PE, the lower the better. Okay, so you expect the PS, price to sales. So the PS is likely to drop further if the share price don't go up. Okay, but the revenue improves. Right, so it's some of the recovery is not priced in yet. Okay, and the other way to look at it is that this is 21.9 high, right? Look at stock chart easier, right? 21.9 high. Has the share price recovered to 21.9 high? No, right? Okay, but if you expect it to recover, fundamentally, eventually the share price should surpass the 21.9 high. Understand? You're just using logic to interpolate. And so sometimes investing is not like you have a magic number, look for every stock, you find your answer. You have to use a bit of logic. Sometimes the market will price in, sometimes the market may not price in. Right? So I think they haven't priced in the full recovery yet. Okay? Get So it's a monopoly, high margin business, very difficult to find this kind of monopoly stock in the world. Okay? Most of the big businesses are in oligopoly market, which means you have a few big players. Okay, so far we see CPO is an oligopoly market, but for AOT it's a monopoly market. If it's a monopoly market, usually you also have a premium on the multiples. You won't buy it cheap one. Okay, very, very unlikely you will buy it at very cheap prices. I can tell you, even if during the COVID crash, right, at this point in time, maybe the price to sales is still about 20 times. That means the P can be again 40, 50 times one. And it is not expensive. Okay, because if you want to wait until PE go to single digit, you will never buy it because it never happens. Okay, yeah. Okay, last one. Oil and gas stock, PTT Exploration and Production. It has a parent company called PTT. Okay, so PTT is the group itself, and it is 51%. Yeah, wait. So this PTTEP is about 64% owned by PTT. Then in turn, PTT is 51% owned by Ministry of Finance. So indirectly, this is also owned by the government. Right? It's the largest oil and gas exploration and production company in Southeast Asia. Okay? To give you some sense, and majority of their oil assets comes from Thailand, not surprising, Okay, 45%, 24% comes from other parts of Southeast Asia, 16% comes from Africa. Okay, there's an interesting observation which I will share with you again later. This is the trending of their reserve, and this is a good sign because you want the reserve to go up. We all know that there will not be oil and gas assets growing on Earth, okay, because it takes billions of years to create this oil reserve. The only way is you go and take the market from other people, or you go and discover new oil wells. Okay, so this is a depleting asset. Okay, and yet they can grow their reserve, which means that they will have been able to extend their business to many, many more years to come. So this is a good sign. You don't want the reserve keep dwindling, right? That means the ability to sell more oil in the future is not there. Okay. Then the next thing is that they also publish their cost per barrel. Okay, and this cost per barrel is not just to how to say dig the oil out. Right? It includes all these expenses. Okay, all these expenses. Then they end up with about $28.36. Okay, because it's not just lifting it out. Lifting it out is only $4.42 per barrel. And you add in the rest, including the depreciation of the equipment, it will cost them about $28.36 per barrel. Is this good or bad? You must get some sense, man. How do you know it's good or bad? I see a lot of question mark. How do you know it's growth fat? You compare with what? Compare to what? This is their cost. So you compare to what? Oil price, right? Is oil price easy to know? What's the oil price now? 70, 60 plus? Do they make money? Make money, right? So that's how you assess. But at least you know where the cost price is a very powerful thing already, right? So you know that there's a very big margin of safety with even if the oil price going to come down. Okay, this is oil price. It has fallen, right? Last year is about inflation. Inflation went up. Then since about middle of last year, June 2022, peak inflation rate has been hit, and oil prices just slide all the way down until this year. Okay, and it is expected that the next year or so, oil price is going to go down further. Okay, but it's still going to range around 60 plus per barrel. Of course, these are projections. At 60 plus per barrel, will they still make money? Yes. Okay. All right. So that's how, if you know this, some of these key numbers, right, you know what to do. Okay, you know how well they will fare. And the futures market also will give you some clue. This is a projection from the US side. Okay, from the energy department. And on the right is what the market thinks. It's different. Right? One is by the researcher, by economists. The other one is by market participant. Market participant also say the same thing. Okay, there's a backwardation in the futures market, which means that the future contracts are cheaper, which also means that they predict oil prices going to fall. Okay, but even if they fall, plus. Okay, no problem for PTTEP. Okay, and this is the dividend that they give throughout. And of course, 2022 is a very good year for oil and gas. You don't expect this dividend to continue this year. Okay, likely it's going to be lower, but can still be higher than 21.9. Okay, but we all know what happened to 2020 and 2021, right? Anyone recall what happened to oil price during COVID? Never happened before in history. Yeah, it went below zero. You remember? Oil price went below zero. I also don't know how you buy. That means you order, they pay you money, and plus the oil. Very weird, right? Okay, the market just go haywire. And there was a period where nobody wants the oil because there's no more space to store. Okay, because all the factories shut down, right? The use your public transport, your cars don't move. The demand for oil just tank. Okay, and yet they gave dividends. Powerful. Oil price went zero, below zero. They still give you dividend. How is it possible? If they don't give you dividend, right, you understand, right? It's like, wow, you're suffering. Never mind, I got enough money. But they still give you. And it's not little, right? It's quite comparable with the past dividends. Okay? And the reason is because, where was it? Okay, I think I didn't put it up. Okay, the reason was because they have a lot of cash and they have built up their profitability over the years. Yeah, and they're quite steady. Their payout ratio is about 50%. Except 2020, you can see they pay out 71%. They pay out a bit higher because they don't make money, that much money. But actually in 2020, even when oil price went zero, below zero, they still make money overall. Because it just dipped for I think about a few days below zero. Then after that, it went back up already. Okay, so for the rest of the year, they still make money, just less than other years. Yeah. So that's why I say it's a good thing, right? Because the last 2 years is a testing ground for a lot of companies. You want to see them able to tide through and still deliver results. Okay, so you can see PTTEP is also one of them, right? Of course, AOT suffered the most, right? And still recovering. But this one recovered last year already, right? Because oil price went up a lot. Okay, from zero, then after that to about, did it go to 100? I can't recall last year. Possible, okay, but you check the numbers. Right, the growth is also there in the teens. Okay, for this kind of stock, right, you see the PE is lower, right? Okay, so these are cyclical company. You also have to be careful. When the years are good, like 2022, right, record earnings, right, what will happen to the PE? Very low. Okay, so you must understand for cyclical stocks like oil and gas company, you probably have to use forward PE. Okay, you have to look forward in a down cycle when oil prices are down, are their profitability affected? So the PE forward is 8x, which is still not expensive. Free cash flow yield also higher than 5-year average. Dividend yield is also quite high, right? 6.5 over 5.3%. And you compare to the past 5 years, right? For the past 6 years, they've been consistently giving dividends as well, even in the worst of times. So this dividend is also likely to continue. Okay, so that's how you can sense make. So out of the three, I would say PTTEP is the cheapest stock here. Okay. So these are the SDR, right? And these are the three. The trading codes are here. We talk about CPO first, then we talk about Airports of Thailand, then we talk about PTTEP. Okay, so these are SDR that trades on SGX. So your broker, the broker that you use to buy your Singapore stocks, can already buy these stocks. You don't need a special account. You don't need to pass any exams. Okay, so these are the stocks that you can also consider, right? You don't need to go out of the Singapore market to assess foreign companies now. All right. Okay, so that is the end of my presentation. Okay, these are the three stocks three SDR that I mentioned just now. Okay, and the summaries are there. All right.